You know, Eric, on this show, time and time again, founders talk about the importance of hiring great employees.
And they always say it's so hard and so important early on to hire the right person.
It makes a lot of sense that it's difficult because most founders don't have experience doing high-level searches or hiring top-level talent.
And they're also limited to their local talent pool a lot of the times.
That's why a lot of founders choose to work with SPMB, one of the fastest growing executive search firms in the country. For over 40 years, SPMB has specialized in recruiting upper management and board members to early stage VC-funded startups and larger growth stage companies too.
They bring the knowledge of a large global firm and combine it with the personalized service and attention of a boutique.
They have a dedicated team focusing on the Mountain West and Midwest emerging tech markets, so no matter where you are in the country, if you're trying to hire top-level talent, SPMB can help you out.
If that sounds like you can go to upside.fm/SPMB to learn how they are closing hundreds of C-level searches annually.
So as an ultra high net worth individual, how these people are investing in wine is you have your outdated legacy wine manager who you'll give $50,000, and it's similar to a financial advisor relationship. They buy the wines for you, they store it, they charge you 2 to 3% annual fees.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Woo! Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Eric Hornung, and I'm accompanied by my co-host, Mr. Red or White himself, Jay Klaus. Jay, you're at a wedding. They come up, they got 2 bottles. They go red or white. What are you doing?
I'm going white. I don't know. I think it's probably mood dependent because I don't have a real go-to, but I generally like chilled beverages. And you don't chill red wines. Are there ever any chilled red wines?
So actually, you can serve red wine a little chilled, not like cold, but it's kind of nice. Have you ever heard of like the 20-minute rule?
Nope.
So for red wine, you're supposed to chill it for 20 minutes before you drink it in a traditional refrigerator. And for white wine, you're supposed to take it out of the refrigerator and let it sit in room temperature for 20 minutes before you drink it. Now, I am not a somm, and I know nothing about what that means, but that's a rule that someone told me one time.
I think I have heard that. Well, I haven't heard the red wine side of it. I heard the take out the white wine for 20 minutes. It's an interesting thing. Well, if you're not a somm, I am like extra not a somm because you, every time we're around anybody that's drinking wine, you pull out all kinds of facts and knowledge. I think back to our conversation with Johan of InKind back at South by Southwest, where he showed up with wine. What a guy. And you guys talked for like 20 minutes about wine. And I drank for about 20 minutes about it.
That's the new 20-minute rule. Yeah. When we did this interview, I can't believe that we didn't drink wine because on today's podcast, we're talking wine, Jay.
That we are. We are talking with Nick King, the co-founder and CEO of Vint. Vint is the first fully transparent platform for anyone to invest in fine wine and spirits. They democratize this high-returning asset class with SEC-qualified collections. Eric, makes me think a little bit of our previous conversation with Rally and what they're doing with fractionalized ownership of assets, but we're talking wine specifically today.
I think that this goes back to one of those macro trends that we have here on Upside. And that trend is that the ability to invest in everything is becoming more and more readily available. You can now invest in the Constitution, you can invest in wine, you can invest in watches, you can invest essentially every asset, everything in the world is becoming a financial asset.
It's crazy. I'm interested in this. And it makes a lot of intuitive sense to me, but I'm still a little dubious about the liquidity of some of these investments. So I'm going to be critical in our interview today.
Did you just use liquidity? Was that a pun?
Oh, it wasn't, but it should have been. Wow. I am not dubious about the liquidity of wine. The literal liquidity. It's very liquid. It's not very viscous. Wow, should have claimed that. Vint was founded in June 2019 and based in Richmond, Virginia. Eric, new city for us as well, if I'm not mistaken.
Oh, I love adding a new city. We don't get to do it as much anymore, Jay. Now that we've been to 71, this being 72 cities on the podcast and throughout the Upside network, it's not very often we get to go somewhere new, at least here on the mics.
But when we do go somewhere new, it feels like we are living this one life we have to live the best way we can, Eric.
That's true. And if you want to learn more about how to live the one life you have the best way you can go check out our friends at Ethos Wealth Management. You can go to upside.fm/ethos to learn more. And Jay, I'm excited to get into this interview because I got a feeling that, like your preference for white wine, you're going to have some freezing cold takes.
I don't like my white wine freezing cold. Well, let's see if we can keep this pun train going. We'd love to hear your thoughts on this episode as you listen. You can tweet at us at UpsideFM or email us hello@upside.fm. And we'll get to that interview with Nick right after this.
I hate that we've demonized scheduling links, Jay.
Scheduling links are actually one of my favorite things. I love the ease of someone saying, here's when you can book a time with me. And then I can choose when it's best for me too.
Whenever I get an outreach and someone says, what time looks good for you? I ask them, hey, do you have a scheduling tool? And you know what scheduling tool I wish they had?
Which one is that?
It's a new scheduling tool called SavvyCal. SavvyCal makes it easy for both parties to find the best time to meet.
SavvyCal makes the scheduling process even more savvy than any other scheduling tool that I've seen, and I mean that. It makes it so easy to personalize your link. You can say, hey, this is a meeting time for Jay and Eric, and it just looks so professional, so sophisticated.
So much so that we're going to be using it for Upside going forward, and maybe even rolling it out to the Upside network.
You can use SavvyCal as well. You can sign up for a free account at savvycal.com/upside. That's SavvyCal.com/upside. And when you're ready to upgrade to a paid plan, you can use the promo code UPSIDE for a free month.
I grew up in a suburb outside of Richmond, Virginia. I was a public high school kid. I attended UVA originally as a pre-med student. I quickly learned about opportunity cost through economics classes. I was like, hey, yeah, there's the cost of med school, but there's also the opportunity cost of 4 to 7 years, and got very interested in finance and economics and ended up going down the finance route. And I worked in the value investment industry. So read a ton of books, which I really think books are the number one way that I've learned about both investing and just general business. And that prepped me to join a Richmond, Virginia-based value investment firm called TSW. They manage about $20 billion. I was on the domestic equities team. Great learning experience, really learned just the fundamentals of business and how to think about business in general.
For someone who hasn't had the economics background, who hasn't had an opportunity with a firm like TSW, what are some of the concepts that you learned about finance from TSW that you think normal everyday people should know to better understand the world around them?
Yeah. First, I'd say we are in a crazy time right now, looking through the lens of a value investor. But the main concept that I think gets misconstrued is the sort of diametric opposition between value and growth investing. So everyone's like, either I'm a growth investor, or people aren't as loud about this one now, or I'm a value investor.
Can you outline both of those for people who may not be familiar with the terms?
Yeah, at a high level, growth investor, you're generally thinking about higher multiple businesses. So when you value a business, you generally value it off of some multiple of revenue or cash flow. So if you think a high growth company like a Zoom, it's being valued off of a higher multiple off of its revenue, versus value is generally lower multiple. So generally your traditional businesses that aren't your crazy multiple SaaS businesses, like say a Kraft Heinz. Warren Buffett is the the father of value investing. So that's kind of how people think about the two. However, my team really got me to think about the two in a different way. So value investing is really just looking for a business that is mispriced in any way. It doesn't have to be a cheap multiple. It could be a high multiple business, but people are just undervaluing the growth potential of that company. So a Google at 20 times earnings could still be considered value, even though in the traditional sense, it is greater than the average multiple of the S&P over the history of the index. So I think that is probably one of the main principles, that you don't have to be a value or a growth investor. Second would be look for assets and companies that you can acquire at a margin of safety. And keep in mind, all of this is based on assumptions and it's not black and white. But if you think when you're valuing a company or an asset, it should be valued at $1 billion, and say the company missed earnings last quarter, and there's been this noise that you don't believe should actually impact the intrinsic value of the company, and say it's valued at $750 million right now, that could be an interesting investment. So those probably two principles that I've taken away, as well as that we're in a crazy time right now.
Tell me more about this crazy time we're in.
Yeah. Well, one, I'm a proponent of everything is an asset, but it seems like there's little fundamental analysis being done, and it is not really, the market is crazy. So I guess I'll use an example that I was talking about 2 days ago with a friend, and he's like, yeah, I'm really interested in NVIDIA. He said stocks up to $700, and he's like, they're about to do a 4-to-1 or a 1-to-4 stock split. And he's like, yeah, that makes it a really, really good buy. And I was like, all right, let's take a step back here. Say, I don't know what the market cap of NVIDIA is right now, but changing the stock price of the company should not actually change the value of the company. But you saw Tesla do this, where they split their stock and then all of a sudden it went up because optically it's cheaper. Has the value of the company changed? No, I don't think so. And I think you've seen a lot of this movement of asset prices without the underlying value of that asset changing, whether it's alternative assets or public equities. I'm young, haven't lived through a time like this, but even my former employer, they said this time is crazy. They would always talk about 1999 and kind of draw comparisons and contrast against it as well.
It sounds like you really enjoyed your last job. Why'd you leave and decide to start something else?
Yeah, I did. I really did, which made it a little bit of a tough conversation when I had it. So I think about things through a very analytical manner. I guess a third principle that I didn't touch on that TSW introduced me to was risk reward. And right now, at my age and the market environment, I was like, okay, I have this really interesting concept that Patrick, my co-founder, and I had been thinking about for over a year. Let's lay out the risk reward here.
Yeah, tell us about this concept that you had with a friend of yours that you'd been thinking about for a while. What was the origin of that concept, and what is the concept?
Yeah, the origin of the concept was seeing a Fundrise at a real estate platform when I had some downtime after breaking my arm. I was just reading about the company, read its filings, and I was like, oh, this is pretty interesting. This Reg A plus thing is interesting. So I dove more into that. I was familiar with alternative assets. This was mid 2019. So these current platforms like Rally and Masterworks were still pretty new. And I looked at the wine market as I had seen a chart with its returns, and it's like, okay, this is a really interesting market, thinking about it through the lens of an investor. So what stood out to me initially, and kind of the origin of Vint, was the wine market has strong returns, low volatility, low correlation to traditional financial assets, and it's a highly inefficient market. So when I say inefficient, yes, it's operationally inefficient, but I think about the economic inefficiency where the prices of wines can vary so widely across regions, across sourcing channels. So a bottle of wine could cost $1,000 in the US, $800 in the UK, and $1,200 in Asia. I was like, this is interesting. Thinking about margin of safety, you could really acquire wines at a margin of safety. So 2 years ago, we were thinking about this a lot. And that's when Patrick and I got together. We had just started our day jobs and we kind of just spent time looking at the market and had as many conversations as possible. As we had more conversations, we started to learn about more and more of the problems in the industry. So current ways to invest in wine are pretty outdated. It's sort of your legacy financial advisor type of model. And secondly, there's this black box element of investing in wine where you give someone money, you don't know what you're getting. And then it's like, okay, I trust you. That's not really how people invest in today's day and age. Third were high fees across the industry. And then just general information asymmetry. And that is driven by lack of transparency. So with all of these problems in mind, we just thought of business models. One resource that we had was time. And we're like, let's keep working. We've got an interesting concept, but we have some time to think about models. So we had thought about a data-driven hedge fund. So take advantage of these arbitrage opportunities. Patrick has a data background as well as software engineering. Downsides there were scalability. And then we thought about a StockX style marketplace for fine wine. And I think that will exist. However, we did not have the capital to pay the legal fees to get that up and going. Interstate alcohol law is pretty crazy. It dates back to like really prohibition era. So this thing called the 3-tier system, basically it's going to exist. And that's just how it is in terms of how entrenched they are in the government. So we ended up coming full circle back to that Fundrise style offering, which is a Reg A plus marketplace. And I can pause there before going down that path.
Where does the data for the wine industry come from? Like, what was the chart that you saw to know that there was high returns and low volatility?
Yeah, so there's a few sources. The main data source is this company called LiveX. So they've been around for 20 years or so, and we're set up as a trading partner on their marketplace. They're kind of the stock market for wine. In addition to execution of trades, they are a big data player. So they had a chart dating back to 1988, I believe, and it showed that wine had, in fact, outperformed the S&P with low volatility. So think about it on a Sharpe ratio basis. It's a really interesting asset in that manner. And really, the low correlation is what I found to be really the most beneficial to a portfolio. In '08, the S&P was down 37%, wine was down 1%. It's like, okay, this is interesting. And I don't give investment advice, and I would never recommend someone to put 100% of their portfolio in wine. But there's a reason that ultra high net worth individuals have 5 to 6% of their portfolio in these collectible type assets. It is for that hedge.
Are you saying that LiveX is like a curation of the public stocks of wine companies? Or are you talking about like bottles themselves?
We're talking about bottles themselves. They curate data from their actual marketplace where there is trading that is happening, and two, from general wholesalers, merchants. So their market value is generally the low price in the market, and then they'll have bids and offers off of that. So yeah, that's where we acquired the last 20 years of data. We started to look at this data in comparison to wine scores, vintage quality, and thought we could build kind of this large econometric model of wine scoring, weather data and production quantity, outstanding supply that is in the works, but that itself is not a business. We needed to get a product out first.
So are you saying high net worth individuals who are putting 5+% of their net worth into wine, they're literally going on a marketplace like this, buying the bottle and then putting it in a vault somewhere?
They could be doing that if they're a really self-directed individual, but LiveX is primarily a commercial channel. It's not really an individual collector channel. Sure, there are some on there, but it's primarily commercial. So as an ultra high net worth individual, how these people are investing in wine is you have your outdated legacy wine manager who you'll give $50,000, and it's similar to a financial advisor relationship. They buy the wines for you, they store it, they charge you 2 to 3% annual fees. A second model is you have this wine consultant type of person where you own your own cellar, but you're going to your local wine guy or gal, and they are going to be telling you, okay, here are some interesting wines that we've gotten in. You should think about adding this to your portfolio. But broadly, I would say it's sort of just an unsophisticated process. It's very much driven by personal biases. Like, I like this wine, I don't like that wine, which is fine because a lot of people do this because they're going to consume the wine. But that is kind of the two ways right now that these ultra high net worth individuals invest in wine, through the advisor type relationship, or they're kind of picking / working with a consultant and storing it in their own cellar.
Wine because it's consumable, it has a different decision tree at the exit, right? When you're selling it, you can either consume it or sell it. And then you have to also have the discipline to actually sell the wine and when to sell it. How does that work in the legacy system today? When do I decide, okay, I'm going to drink this bottle of wine even though it's worth $100,000, or I'm going to put it out at auction? How do I even know when it's the right time to do that?
Yeah. When you're going to drink, there are a few variables you're going to look at. So there are drinking windows posted for wines. Those are generally very wide. And I've actually heard that wines are still good after the drinking window. We're talking like 40-year windows. So from the consumption perspective, it's really just a personal decision. It's in the drinking window. I have this big event, or the event itself is opening up a $100,000 bottle of wine and I'm going to consume it. That's purely a personal decision. From an investment side of things, you're going to look at the drinking window as well. But I believe that in the legacy system, you're just kind of looking at the market prices. Wine is highly driven by supply and demand. If you've noticed that supply has been dwindling while there's been articles written up about a certain wine in this vintage, then it could be an interesting time to sell. But once again, I think it kind of stems to lack of sophistication. It's not data driven. It's, hey, I think this is a good time to sell, and this might be one reason why. But why don't you have 3 reasons why? And those are supported by data. The wine has been, you look at LiveX data, any wine that gets listed or that's been on there, it's generally being traded quickly. Demand would be high. You continue to see decreasing supply. We think there could be a better way to decide when to sell, whether you're looking at rescoring data and say after a rescore, the wine pops and then it kind of returns back to its general trajectory. Could be an interesting time to sell. We think a lot about catalysts. That could be another time to sell. But yeah, those are kind of the different ways.
Eric, you spoke about drinking this as if it's a financial decision. Do you take a loss when you drink an expensive bottle of wine? Can you put that on your taxes?
I'm not an accountant or a CPA, so I'm not sure, but it feels like it.
What do you think, Nick? Is that a thing you can do?
I don't know. I've actually never been asked that question in 2 years. So I don't know.
Well, talk to us about Vint today and the vision of the future of wine trading that you're trying to build.
Yeah. So I'll go back to Reg A Plus. We started that process. I know you guys have talked about Reg A Plus in the past, so I'll spare you the details there, but we started the process 8 months ago, and we got qualified about a month and a half ago. In that time, we recruited a team of wine experts. So we have 2 masters of wine. There's about 57 of them in the US. We have an individual who ran a wine investment fund, and then an importer. We built out our product, and we raised a small friends and family round to complete the SEC qualification phase. Probably most notably, we built out the supply side of the marketplace, and I will touch on what exactly Vint does. But we currently have access to over $1 billion of fine wine and spirits, which we'll be expanding into. But why we did all of this is Vint takes and sources wine and files it with the SEC and offers shares to both accredited and non-accredited investors, effectively removing any barrier to entry so that people can invest. And we really pride ourselves on being transparent, both from an investment side of things. So for each collection that we put out, so for this first collection, the California collection, we put out our thesis, a 1-page document outlining here are the key variables, here is the stats, the price chart, and here's what might be changing, which makes it an interesting investment. And then on a company level, we try and be as transparent with our users and community as possible, because when you make an investment, yes, you're investing in the wine, but you should probably want to know about the company and also those underlying wines on a go-forward basis. So today we have listed 1 collection. It was the California collection, market cap of $46,000, 1,000 shares, $46 a share. And that was a few weeks ago. It sold out in 50 minutes, which was a fun day. And we currently have 4 more collections that are lined up in the next few months. So these collections include a Super Tuscan collection, which is a narrative-driven collection where these winemakers went against the grain of traditional winemaking in Italy to make wine in a better way. We think we're doing that in the wine investment industry. Third is a Saint Emilion upgrade collection. And this is one area where I think we really add value, is kind of creating alpha in the wine market through catalysts. So looking at the region of Saint Emilion, which is on the right bank of Bordeaux, every 10 years, there's this upgrade conference. So in 2012, this producer, Figeac, was supposed to get upgraded. So they had been making good wine, but they did not. Over the past 9 years, they've continued to make good wine. And in 2022, it's looking like they could potentially be upgraded. So we bought a lot of that. Producer diversified it a little bit with another, and we're taking a bet that they will get upgraded, and that's Catalyst. We have a champagne collection, which is
real quick.
Similar.
What does upgraded mean in this context?
Yeah, so there are different classes in different regions of Bordeaux and really across the global wine ecosystem. So in this specific region of Saint Emilion, they're currently at the 2nd tier. And in this conference, both producers could be upgraded and downgraded. So they could be upgraded to that 1st tier in that region. So after the Saint Emilion, we've got a champagne collection, a kind of a macro-driven bet, and finally a Laurent Ponceau collection, which is a special situation. We believe we're the only people in the US with these wines. I haven't seen any supply on the market. Laurent Ponceau, for anyone who's seen Sour Grapes, is the French individual who helped crack the Rudy Kurniawan case. He's coming out with a book in the next few years. So we have this catalyst of limited supply mixed with the fact that this is his first vintage. So think of it like a rookie card vintage of his new brand. And he's coming out with a book. So this kind of 3-pronged investment case. So that's over the short term. Long term is whiskey, futures, potentially vineyards, really diversifying across the industry.
You're using the word catalyst a lot here, which, if I'm reading context clues, this seems like an investment term to say, we believe there's going to be some sort of event that's going to cause the value of this to increase. And you're even saying that by having this marketplace, you might be able to act as a catalyst for some of these wines to increase.
Yeah. I think about catalysts a lot. It's another way to add return potentially in the wine market. You have supply and demand, which is driving return. People consume these wines, it ages, it gets better over time, and you have that element. But if you can throw a catalyst on top, whether it is potentially change of hands in the vineyard or the estate, an owner is putting greater investment into technologies, a Ponceau type of event where it's his first actual vintage, the Saint-Emilion. I think that is a really interesting way to add return. But I also think Vint can serve as a catalyst for winemakers. So from a high level, when you're investing on Vint, there's kind of a few bets that I think people are making. You're betting on the underlying wine, supply and demand, all of that economics. You're taking a bet there. Second is there's a macroeconomic bet where we've pumped a bunch of money into the system through fiscal stimulus. People are concerned about inflation. Investors like tangible goods in times of inflation. You're kind of making that bet. And then a third way that you could win as an investor is the platform grows. So there's a finite supply of assets on the Vint platform right now, and demand is outstripping supply at the moment. If that continues and the user base continues to grow, we continue to scale supply, but we just can't meet demand, then prices will go up. So we'll have a secondary trading market, and there's a fixed amount of supply with more capital flowing into the market. Then in theory, prices would go up. So that's kind of a catalyst of the Vint platform. We've also explored emerging winemakers listing their wines on the platform, and Vint becoming a catalyst to being considered a top tier wine. Like if you're listed on this platform with the likes of Screaming Eagle, Harlan, Opus, your first gross, then hey, maybe this emerging winemaker should be considered in this group.
At what point does the quantity of wine on Vint lead to like a decrease in the quality?
Yeah. So the fine wine market is valued right around $10 billion. And let's extend this to whiskey as well, because whiskey will become a large portion of the market. The low hanging fruit in the wine market is about $500 million of high quality wine that we could access in the next 2 to 3 years while keeping quality high. So there certainly is a diminishing marginal return when you get to a certain point, which is why we want to diversify. I don't know what that number is. I couldn't tell you, but I would say somewhere around $1 billion a year. Once you pass that number, then quality may have to drop. But you look at whiskey, you have the playbook of secondary market whiskey, such as casks or your Macallan bottles. But you can also look at young whiskey. And I know private equity has started to look at buying whiskey at time T1, right as it is produced by this big distiller, and then just holding it, aging it, and then selling it to independent bottlers. That's another big sort of tranche of supply that we can get into. But yeah, there probably is a risk there, but the numbers are bigger than what people think on the surface.
What other industries, you mentioned whiskey, what other industries are interesting, whether or not they have a secondary market developed, that might fit into this model?
Wine and whiskey are the primary two, and whiskey is even more opaque than wine, which I think presents a bit of opportunity as well. I guess a third offering style would be futures. So there's this really interesting system in Bordeaux that basically winemakers are able to sell their wine in advance through the en primeur system. So being able to access that market, list those wines, make those available for investment for your retail investor is another interesting avenue that we can go down. And those are really kind of the three primary areas that we're focused on at the moment. We've heard other people mention types of luxury goods, but I believe the supply is large enough in this wine, whiskey, other spirits arena that we should focus here right now.
You had your California collection. It had a market cap of $46,000. So theoretically, you guys outlaid somewhere near that amount of cash to just acquire the collection. And then shortly thereafter, money comes in, probably pays that off. I'm just curious how the model in this world works of acquiring assets that immediately get kind of paid off if you do your job well. Is this like a loan? Does this have to come from a bankroll of cash that you guys are on top of?
So we did acquire these assets outright at first. If you think about that business model, that's a really tough business model. If you are acquiring millions of dollars worth of wine, filing with the SEC, selling shares, there's like significant inventory risk, and all of a sudden this startup type business becomes pretty capital intensive if you have to do that. So what we do is it's a really interesting model. We set up purchase option agreements. So we work with suppliers and we say, hey, here's the collection of wines we want to acquire. These suppliers have deep supply. We're talking one has about $500 million of wine in their ecosystem and can source anything that we would need. And we say, here is the Saint-Emilion collection that we're putting together. At what price could you guarantee this for the next 2 months for us? So we determine a price. We file that with the SEC because we now have the right to buy the wine, and effectively we own it as long as we sell out the collection. So we use these option agreements, file them with the SEC, list the wine on the platform, and then we pay the supplier once the collection is sold out. So for the next 4 collections, the working capital needed to acquire those wines is $0, which is pretty great.
It's just the legal fees, I'm assuming, which are probably not insignificant.
Yeah, it's high right now, but we've overcome the initial Reg A plus hurdle so that going forward, it will become much more of a plug and play type of model. Each collection, you just add that to the 1A document, which is a living document. You file an amendment and it does become a quicker process going forward. But yeah, you saw Rally Road raise I think it was like a $50 million debt facility to acquire the assets. So there's options that are outside of raise a $5 million seed round and use half of that to buy wine. Like, I want to run a capital efficient business.
On your guys' FAQ, it says that you do buy wine. You align itself with investors and purchase between 0.5 and 10% of each offering. Is that going to be a strategy deep into the future, or is that just a for now thing?
So that is in reference to the shares. So with each collection, so for the California collection, I'll just use that example. There were 1,000 shares. We bought about 4% of that offering as a company. So we do that because we believe it is an interesting investment. So we want to tie our incentives with our investors. So we are buying the shares. And sometimes we may buy the wine up front if it's hey, we need to act now. This is a really, really good deal. But that is what that is in reference to.
And that'll be a strategy going forward into the future. So everything that gets listed on Vint will have some economic interest in.
Yes, we will buy shares in every single collection.
A while ago, you said you have 2 masters of wine and a guy who ran a wine investment fund that are on, I think you said your advisory board or something close to that. How did those conversations go? Young guy living in Richmond, Virginia, probably not like the wine capital of the world, coming to these people saying, I'm starting a wine business. What was that like?
Yeah. So first I'd say, I don't think this is a wine business. I think it's more of a financial business, but I came to those individuals with, hey, here's what we've got. Here's what I found that's interesting in the market. I am not a wine expert. I don't tell anyone I am. I need people like yourself who have been studying the market for 20 plus years and really coming from a position of, I want to learn as much from you as possible. Those conversations were tough. I mean, in the early days, we probably had 10 to 15 conversations with people like that, and they just were kind of like, no, not right now. I was like, well, you're like talking to us like once or twice a month for equity in the company. It's not that bad of a deal. But as the company progressed, the conversations got easier. I started to learn more, and I could speak a bit more of the wine language with these people while still coming from a position of humility, like you know a lot more than me. And actually, there's a really funny story about one. So the importer, his name is Kevin. He's got an interesting financial background as wine. So we probably talked maybe 9 months ago, and I just got an intro to him. They're like, he's interesting. He lives in Charlottesville. So the call basically ended with, "I'm surprised at how little you know about wine." And we laughed, and I said, "Yeah, you're actually the first person who has noticed that in almost a year of calls." So what I did and what I do with a lot of people is I just continue to send them monthly updates, quarterly letters. And he reached back out. He was like, "Wow, you guys seem to know what you're doing more than I had thought." And about 6 months later, he actually came on and is a part of the advisory board. So we learn quick, but I also don't think we try and overplay our hand. Like, these are the people who are helping us make those investment decisions. We're running the platform, we're building the platform, we are acquiring users and applying a bit of the sort of nuance and data-driven decision making to the selection process. But those are the experts.
Do you like wine?
I do, and I will say it is not a huge personal passion. And why I think that's good is that I take a completely outsider perspective to the market. This market, and we're only targeting the fine wine segment, but it's broken in that it's a very intimidating market to enter. I've been laughed at for mispronouncing names of wines. It's like they're not the easiest things in the world to pronounce to begin with, but I like the story of this agricultural good that I just don't understand why it has been sort of altered and made so exclusive. So I really like brands that are trying to kind of remove that exclusivity in the market. But it's funny, on the team, people kind of, we rank our customers' wine knowledge or like love for wine from Billy, who's our head of wine, certified som, and really, really strong team member. Then there's me, who's kind of mid-tier, like, different varietals. I like wine. I'll take pictures of bottles on Vivino. And then there's Patrick, the tech guy, who does not know anything about wine, doesn't really care about it at all, has a handlebar mustache. And that's how we compare our customers' knowledge and love for wine in our customer interviews that we do.
We've had Rally on the show, and we've been exploring some other financial models like digital art and things on the show. And it seems like we're in a very nascent time for things, digital assets and fractionalized assets like this. And besides real estate, is there precedent for fractional assets like showing a return that is realized for people, or is this really early?
So it is definitely early. We're in the early innings, but the precedent that I would look to in the alternative market are the exits on Rally, on Collectible. I believe Collectible, which is the sports card company, has an index that they publish of their exits and potentially the trading market data as well. So that is a question that I get asked a lot, is like, what is the exit strategy? So within the wine market, we're kind of an unprecedented platform. So I don't have a data source to point to of, here is like a perfect, clean return profile of exits like this, but we have multiple channels to exit through. And we have Vintfolio, which is a network of 7,000 collectors that we can exit into. Our suppliers and merchants that we work with have offices in Asia. And Asia is a really interesting market because generally there's a 10 to 20% premium applied to wines in the Asian market. So We have options. Those include those two auction houses, all of which that we can exit into.
Well, Nick, this has been awesome. If people want to learn more about you or Vint, where should they go?
Yeah, Vint.co. We have a wait list that's up. We run everything through a wait list. And for myself, I'm not a personal social media user, but you can shoot me an email, nick@vint.co.
Jay, what's your favorite podcast app named after a fruit?
Gotta be Apple.
Can you think of any other ones?
I tried really hard, but I didn't want to wait for too long. I didn't want too much dead air.
Hey, you know what's worse than dead air? Not getting reviews on Apple Podcasts from your listeners.
Oh my gosh, it is the worst. Every day that I wake up and I don't have a new review on Apple Podcasts, I just look up at the sky and I go, ah!
I like how the first thing you do when you wake up is to look at Apple reviews.
If only I was lying. But I'm not, and I'm looking for new reviews for Upside on Apple Podcasts, Eric. And if you are listening to this right now, you could be that person that helps get the day started right.
All you have to do is go to Apple on your iOS device or web browser, log in, and leave us a review. 5 stars would be nice. 4 stars would be great. Let's do 5 stars.
Let's do 5 stars. Definitely prefer 5 stars. Even if you don't use Apple Podcasts as your preferred listening app on an iPhone, please take a moment to rate us there anyway. It helps us bring on great guests. It helps us climb the charts. Our show will get better if you do this very simple act. So please. All right, Eric, we just spoke with Nick King, the co-founder and CEO of Vint. Where would you like to start this little debrief?
Well, first you got to put your nose in the glass, see what you smell, look at the color, really understand it, give it a little swish, and then say that this is a really cool idea. I like what Vint is building.
I looked into my glass of wine, I swished it around, and I said, I think this has legs.
Oh, that was awesome. Man, what a setup by me. Didn't even notice I was going to do that.
Slam dunk.
So when we opened up, we talked about how this is so on trend for what we're seeing across a lot of the conversations we're having here on Upside. From Mainvest to Rally, it's all about alternative investments and not just being traditional fund investments, but being able to directly participate in something, whether it's an NFT, a business, or a commodity or collectible. And I think that by focusing on one niche, like wine, Vint is going to set itself up to be a thought leader in wine valuations, in wine investing, and potentially be able to onboard its platform into other platforms that are focused on alternative investments as their kind of wine offering.
And we already see them expanding into spirits. Even Rally, they started with muscle cars. So it does seem like with a lot of things, you start with something, you do it really well, then you can expand out into related industries. But what I would never have guessed was that fine wine has returned 9% annually and has low volatility over the long term. Like, I just never would have thought about wine as an investment asset. It's not just that it can be an investment asset. It's actually already an investment asset for some people. The process is just not very accessible or well known.
I have a weird exposure to this because when I lived in New York, all of my managing directors were wine collectors, and they did it not purely for investment. It was mostly to tell each other that they had a certain bottle of wine, but there was a financial aspect to it. And there's something about being able to know that you can sell this bottle for X thousands of dollars. So to someone who can't buy or doesn't know how to buy or can't get access to a vineyard in the south of France, it's just a very hard space to get into or to allocate a small percentage of your portfolio to.
What do you think about the difference here, though, of let's take those people that you were around in New York who had the bottles of wine literally in their possession. So part of the thing was to be able to show like, hey, I have this. Then you can also drink the wine if you wanted to. In this world, it seems like it's more purely a financial asset because you can't have the same enjoyment of holding it, showing it off, drinking it if you wanted to. Do you think that's a problem?
I don't know that it's a problem. It's something we came up against with Rally as well, which is the tactile ability to feel something to say I have ownership over it versus just having exposure to it financially is, yes, it's going to bring in a different crowd and it's going to make something less likely to maybe go viral. But I don't know that it hurts wine per se here as a financial asset, because one thing that the ability to invest in wine does that the ability to buy it doesn't is say I am on the same level as these people, smaller amounts probably, but I am able to invest in wine. And I know that it's a good investment because rich people do it. When I look at Vint, one thing that I'm curious about is how they launch. So right now they source, they get the offering together, and then they do a first come, first serve. You get in, you get one of the shares, it's yours. That creates almost I don't know if Supreme still does this, but Supreme used to do drops. That creates some virality around people showing up, but it also creates people who want to be investors not being able to get shares if they're too good at what they do. You know what I'm saying?
No, I don't know what you're saying.
So if there's only 100 shares out there of a certain collection of wine, and I'm really into buying that, let's say it's the Super Tuscan collection, and I know this from experience, then if I don't get in the first 6 hours because I'm busy or working or whatever, and it sells out, I now cannot, because there are no secondaries, there's no secondary offerings, there's no platform for me buying and selling that. There's no way for me to get exposure to that collection that I was really excited about just because of timing.
And so what's the next step to that? Do you think that makes it less attractive to investors, or do you think that creates even more scarcity to make it more attractive for people to move quickly?
I think that it creates virality. It creates the ability for people to be like, I got in and you didn't. It creates hype for sure. But in the long term, I think that a secondary market for liquidity for that ownership is going to be necessary for people to continuously be interested and be able to see the value go up and down. Because in the long term, yes, it might return 9% on historicals, but people don't really care about the long term. People like the dopamine hits, especially as you start going down the chain.
When you look at Vint, or if you even want to extrapolate into some other fractionalized asset marketplace that's specialized, would your excitement around investing in a company like this be tied to your expectation that they would grow into other verticals? Or would you be excited about something that just specifically stays wine and spirits?
For me, no. I think that staying focused and staying verticalized is actually probably a better bet. I look at Hodinkee. Are you familiar with them?
Watches?
Watches. So they started a digital watch magazine, essentially. Created a bunch of content around watches, and they rolled out other products, but everything centered around watches and fine men's living, but really watches. They raised $100 million or sold for $100 million or something like that. I think by being the go-to expert in your field, you become much more valuable to someone who wants to be that expansion mechanism, and you still have the optionality to do it into the future. But I think being number one in wine, because they're not the only people out there doing fractionalized wine or investing in wine or democratization of investing in wine. There's wine clubs, there's wine groups, there's a lot of stuff out there. But if you can be the best, if you can be the biggest, if you can be the place that everybody goes to check their data, to check the pricing, to check whatever, then that I think is a much more valuable asset than someone can do a lot of different types of investing semi-well via a platform that's regulatorily compliant.
Yeah, I think I agree with that take. The other critical part of me, thinks about the stat of fine wine has returned over 9% annually and has low volatility over the long term, which you might look at and just say like, all right, let's just invest in wine all day. But I'm sure that stat is rooted in the limited scope of what wines have been traded as assets. So there's some like theoretical threshold or limit to how much wine can be used as a financial asset, right?
There's a theoretical limit, but once you find that limit, the likelihood is that the value grows. Once it becomes a finite resource or a finite amount, then you get value accretion, because once supply becomes fixed, if demand continues to grow, value rises, price rises. So maybe, yes, you can't do as much from a quantity perspective, but you can do as much or more from a price perspective.
Interesting. I hadn't thought about this is inherently increasing the demand for an already valuable asset, which makes that asset more valuable.
Which comes back to our idea of the more access and liquidity you can give to assets that historically have not been accessible or liquid, likely increases both the price and volatility of them over time, though it's not guaranteed. And that's just our hypothesis.
Let's take a slight right turn here and talk about Nick as a founder. What stuck out to you about Nick as a founder of this company?
I think he's a hustler. He really got after this new regulation, went through all of the hoops and hurdles to get it done, and he doesn't have a big team to do it. He is going through and understanding all of the regulatory pieces of the puzzle. He's studying Rally and understanding how they did it and taking that as a playbook. As someone who used to work in regulatory consulting, it is not fun to do any of that. And to do it on your own as a startup with an idea, I can't imagine many people would spend the time to do it and do it right.
Yeah, it seems like a lot of hurdles and a lot of hoops to jump through. And that's a good mark on Nick's pedigree to me as well. What stood out most to me about Nick was his awareness of his weaknesses and his willingness, and not even just willingness, but his sort of aggressive pursuit of finding people who could augment his knowledge and experience, people who have been in the wine world from different angles for a very long time. And even though he wasn't always successful in getting those people on board, he stuck with it and found what seems to be a really strong team. He said he has 2 masters of wine. There are only 57 of which are in the US. He has someone who runs a wine investment fund, an importer. These seem like really smart parts of the wine ecosystem to bring on board the team.
Who do you think he needs as his next full-time hire? Maybe not advisors, but full-time hire.
Maybe it's the product guy in me, but looking at the page itself, the product itself, it seems like there are some strides to be made in building out the product to make it more user-friendly, more accessible, something that's ready for a higher load.
In the world of Robinhood and the user interface they created, studied, developed over time, that's now the expectation. It's very similar to podcasting, Jay. When we started off, you could launch a podcast, 2 guys, no mics, using your phone and get something that was maybe in the top couple hundred on the Apple charts. Today, the expectation by consumers and users and listeners is so high that you have to clear a different bar to even be in the conversation. And I think that what Robinhood did for investing, the way that they created user interfaces that made it simple to invest, is probably, I think you're spot on, that something like Vint has to feel like Robinhood or better.
And maybe that's a little bit of a ways out, depending on how much supply they can even bring onto the platform in a given amount of time. It sounds like, he had a really smart strategy for how to acquire wine or get it on the platform and be ready to be purchased that wasn't incredibly capital intensive. So it seems like he could scale up quickly in terms of supply. But if he is going to increase demand, I do think that the platform needs to grow a little bit and get ready for prime time.
Are you a fan of strawberries?
Love strawberries.
So I'm not, but I have eaten them before.
What?
I know. We'll talk about that later.
Of course you've eaten them before. Who hasn't eaten strawberries before?
Dear listener, if you haven't eaten strawberries before, I'd love for you to tweet at Jay Klaus on Twitter and let him know that you've never had a strawberry because he's looking for somebody. Anyway, back to my analogy real quick. When you get like a new thing of strawberries and there's like some really, really good ones. They're ripe, they're juicy, they're not like demented at all, they're not too big, they're not too small.
Demented.
Well, sometimes
I love
you get
my
like,
strawberries not demented. Yes.
sometimes you get like the double strawberry. You know what I'm saying? Like you get the one that like has like the little double hump down there. Kind of freaks me out. Then you got the ones that are too small. You got the ones that are like a little rotted, whatever. My biggest shadow about Vint is that right now they are in the, I just opened a new box of strawberries, carton of strawberries phase, and they're picking out all the best collections. And eventually there's going to be some collections that aren't as interesting. And this might be a 5-year, 10-year, 20-year problem. I don't know when it is, but once they start getting there, does demand for those keep up with the supply that they are going to have to continuously be increasing on the site?
That's a good shadow, and I would imagine and hope that by that time they do have a secondary marketplace as well, so that the existing collections can continue to appreciate in value and people can realize gains on that.
So let's jump to what we want to see in the next 6 to 18 months, Jay. What are you thinking besides revenue?
Besides revenue? Well, I'll let you talk about the collections because I know you're going to talk about the collections. I want to see evolution of the product. I do really want to see that product when you land on the website, making it a lot easier to create an account, making it easy from the time that you do create an account to begin to invest in wine. It seems like right now, even if you do create a Vint account, it's kind of up in the air as to when you'll be able to use that because it's dependent on collections, new collections, since there is no secondary market for the existing collections.
I'm pretty bullish on Vint and what they're building. When I'm looking at 6 to 18 months from now, I want to see some data first and foremost around how quickly things are selling out. What is the average investment size? I think that's a big one. And just anything else they can pull about the collections they're doing. Specifically, if there's any that don't sell out, I'd want to know why on those. That would be particularly interesting. And then from that, the kind of next step is, can you underwrite your wine supply selection part of this equation better within the next 6 to 18 months? Can you create some sort of Vint preferred where I don't have to show up within 6 hours? I can just pre-commit to the next X amount of raises for $500 on a commitment letter on each one because I know that I want to do this much per year in wine investing. And by having that, Vint is able to better underwrite, better ensure that they don't have any sales that aren't completed. So I don't know if that's a 6 to 18 months. It might be closer to 18 plus months, but those are two things that I'm interested in seeing from Vint, and I am very excited about what they're building.
I feel like we didn't talk much about their expansion into spirits. How does that play into your shadow of, running thin on good collections? There's all kinds of spirits out there, any type of which has lots of rare and valuable bottles in it.
It feels to me like you got to nail wine first before you really focus on spirits. So while I think it's a huge opportunity, it's more of a shadow to me of getting too much focus right now versus a potential opportunity into the future. I want wine to go really, really well for the next 6 to 18 months and have some structure built out there before spirits becomes the next frontier.
All right, dear listener, we'd love to hear your thoughts on this episode and your thoughts on our takes. Are we drunk with power? Let us know. Tweet at us at UpsideFM or email us hello@upside.fm, and we will talk to you next week. That's all for this week. Thanks for listening. We'd love to hear what you think about this episode, so tweet at us at UpsideFM or email us hello@upside.fm and let us know. You can learn more about us and browse our entire back catalog of episodes at upside.fm. And if you love our show, please leave a review on Apple Podcasts. That goes a long way in helping us bring high-quality guests to the show.
Rocky, I'm Sylvester. One for underrated, two for underpaid. Today I'm gonna get it.